Gold possesses zero yield, carries no credit risk, and relies on no balance sheet. Its physical supply is almost never consumed. It simply accumulates. Under the Bretton Woods system, the $35 per ounce peg functioned as a static monetary anchor. This rigid structure suppressed market volatility by linking the global currency system directly to a fixed weight of metal. In August 1971, the Nixon administration suspended the dollar's convertibility into gold. This decoupling removed the final external constraint on monetary discretion. This chart tracks 24-karat gold from 1970 to 2025. Following the 1971 pivot, the fixed peg shattered, and gold entered a regime of high-frequency price discovery. This volatility quantifies macroeconomic uncertainty, each spike tracing a period of institutional stress. The end of Bretton Woods redefined gold. It became a liquid, diagnostic instrument used to measure the credibility of fiat currency systems. Traditional supply and demand models rely on the consumption of a resource. Unlike oil or copper, gold is a cumulative stock. Nearly every ounce ever mined remains available above ground, meaning its price behavior deviates from standard industrial commodities. Institutional models must price an asset that represents value without a corresponding promise to pay. Its worth is derived from the total absence of counterparty risk. Professional portfolio managers utilize vector autoregression, or VAR, to map these values. VAR is an econometric framework that captures the linear interdependencies among multiple time series, allowing analysts to track gold against complex macroeconomic variables. Gold operates as a matrix driven by real interest rates, segmented institutional demand, and physical supply constraints that cannot scale with market sentiment. Pricing gold requires deconstructing the quantitative algorithms institutions use to measure system-wide trust. Real yields represent the nominal interest rate minus the rate of inflation. This figure shows the actual purchasing power return on capital. Positive real yields create an opportunity cost for holding an asset that pays no interest. Investors essentially pay a premium in lost earnings to hold physical gold over interest-bearing debt. Gold prices and real yields maintain a strict inverse historical correlation. When the return on sovereign debt rises, capital rotates out of gold and into fixed income assets. The 1980s Volcker rate shock provides a rigorous empirical test of this link. Aggressive central bank tightening pushed real yields into positive territory, forcing a gold price collapse as the cost of holding the metal became unsustainable. In the post-2008 environment, quantitative easing drove real yields into negative territory. With government bonds guaranteed to lose purchasing power, capital flowed back into gold. Algorithmic models monitor the deviations between gold, the US dollar index, and TIPS. TIPS, or Treasury Inflation-Protected Securities, are government bonds indexed to inflation. When the yield on TIPS drops, it triggers buy orders for gold. The mathematical opportunity cost of trusting fiat currency determines gold's baseline trajectory. Total gold demand is highly asynchronous and must be segmented by behavior to be accurately modeled. This breakdown shows how different sectors respond to varying economic stimuli. Investment demand, including ETFs and futures, is a highly elastic component.
Driven by interest rate expectations and risk sentiment, this sector acts as the marginal price setter, causing the sharpest swings in valuation. Central bank demand functions as a structural hedge. These institutions buy gold to offset the credit and duration risk embedded in sovereign bond portfolios. Official sector accumulation has accelerated since 2008. The People's Bank of China and the Reserve Bank of India maintain thousands of metric tons, using gold to diversify away from heavy dollar concentration. Cultural and jewelry demand, primarily from India and China, provides the largest physical anchor in the demand stack. In Asian markets, gold is a primary vehicle for household savings. This creates a structural floor that absorbs physical supply, even during global macroeconomic downturns. Speculative investment drives the market's peaks, while central bank reserves and cultural tradition forge a yielding physical floor. While demand is a behavioral matrix, the physical supply chain is governed by distinct time lags and extraction costs. Primary mining output is highly inelastic. Because new projects require massive capital expenditure and development cycles of up to 10 years, production cannot scale rapidly with price. The all-in sustaining cost, or AISC,
captures the total recurring expenses required to produce an ounce of gold. This figure creates a natural floor for global valuation. If prices fall toward the AISC, marginal mines close and supply tightens. Recycling is the only supply lever capable of responding to short-term price shocks. Recycling spikes correlate directly to price peaks. When gold revalues sharply, households and investors monetize existing holdings, providing an immediate liquidity release valve for the market. Because physical supply cannot be expanded through policy, gold retains a mathematical scarcity that fiat systems cannot replicate. Beyond macroeconomic fundamentals, modern gold pricing is executed through high-frequency trading and algorithmic risk management. These daily price fluctuations are the primary focus of institutional quants. They do not attempt to forecast an absolute price, but instead model the shape of the volatility itself. Managers rely on GARCH models, generalized autoregressive conditional heteroscedasticity, to estimate conditional variance. This identifies periods of volatility clustering where price movements are most likely to accelerate. Gold displays an asymmetric volatility profile. While equity volatility typically spikes during sell-offs, gold's volatility clusters during risk-off environments as capital scrambles for safety. Algorithms trade gold as a quantifiable index of systemic fear, a direct metric of counterparty risk. The spot price is formed at the intersection of three forces: the inelastic physical floor of mining costs, the structural demand of reserves and culture, and the mathematical opportunity cost of real interest rates. Gold operates as a closed-loop, cumulative stock system that audits the stability of the global financial architecture. It remains a constant measure of the fragility of modern monetary policy. In an era of digital assets and expanding sovereign debt, the physical permanence of gold forces an objective discipline on subjective decisions. Gold transforms systemic uncertainty and institutional trust into a continuously measurable, non-defaultable signal.